Welcome, everybody, to the Retirement Power Hour. My name is Joe Allaria, and this is episode 14. And today we are going to be joined by my co-host, my periodic co-host, Jay Waters. Jay is a wealth advisor here at Carson Allaria Wealth Management. Jay, thanks for coming back to help me out today.
Yeah, absolutely. Looking forward to our discussion today, Joe.
And Jay, today we are hitting a topic that I love talking about because I love to debunk a lot of narratives that are out there that are really not true, because we're doing this to help the common investor, to help the everyday investor. So what we're going to talk about today, Jay, is some myths of retirement. And this is going to be a two-part series here because there are just so many myths out there. So we're going to cover the first 5 myths of retirement today, and then we'll come back for a part 2 and cover a few more. So I'm excited. I think there's, like I said, there's a lot of things out there, a lot of rules of thumb, a lot of narratives that you hear, Jay, that I don't know about you, but when I hear them, I just cringe because people are taking these things as gospel and they're not true. It's not that they're false all the time, but they're not true 100% of the time either.
Right. Yeah. There's so many different things out there that say you have to miss it, do this right, have to hit these marks where, again, just not true. There's every different scenario for each person. So people throw out the blanket statements and they try to apply it to their situation.
Yeah, absolutely. And before we jump into the first one, Jay, I want to remind everybody that's watching, if you want the entire episode, which will include a frequently asked question or a question from a listener, go to Spotify, go to Apple. You can listen to the entire podcast on those platforms, or you can go to retirementpowerhourpodcast.com as well and listen to the full episode there. So, Jay, the first myth that we're going to talk about today, if you reach a certain dollar amount, let's say $1 million or whatever number you've been hearing lately, but I've heard $1 million. If I reach $1 million, I can safely retire. Why is that not true?
So when it comes to the number that you need to have for retirement, it's all going to be based on what your living expenses are going into retirement. Also depends on if you have any, pension, Social Security, depends on what those amounts are too. Typically what we see is, depending on those expenses, you may need more than $1 million or you may need less than $1 million. I've seen lots of times where clients only have $400,000 or $500,000, live below their means, live a simple life, or maybe they have no debts. And between Social Security and, withdrawals from the 500, they're completely fine. They have no chance of running out and, they can sleep easy at night. And then again, there's people that have, $1.5 million and they spend, they try to keep up with the Joneses next door and, $1.5 million ain't going to do it. So it all depends and boils down to what your expenses are.
Absolutely. Yeah. Expenses are one thing.
Yep.
And I think you touched on it, but what income sources do you have coming in? I speak with a lot of people and I have a lot of clients that they not only have a 401k, but they also have a defined benefit pension plan from either their time working at a company, for a public institution, for the government, in their military service, whatever it may be. They have these pensions. So that would change things drastically in terms of how safe are you to retire or not. And that's why you definitely can't just base it off of the size of your portfolio. I've seen people that had basically nothing in a portfolio, but between 1 or 2 pensions and 2 Social Security benefits, between a husband and wife, they're doing just fine. They don't need any portfolio. They don't need anything in a portfolio. They certainly don't need withdrawals because they already have more than enough coming in every month. So if you get to $1 million, great. That's fantastic. But it doesn't mean that you can automatically safely retire. And everyone has their own number, and you really need to get a detailed retirement plan done to figure out what that number is for you. Jay, you said some people retire safely on 400,000, on 500,000. Yep. The second one, Jay, your investments should be conservative in retirement. And we might make some people mad on this one because we're saying that's not true. Why is that? Why are we saying that's a myth?
Yeah. So, everyone probably hears it is as you get older and older, the more and more conservative you should be. And that may be the case, but again, not everyone's situation is the same. If,
Yeah.
Relating back to what if somebody already has the pensions and Social Security and
Right.
that's more than enough of what they need? Well, let's say they did save them that $1 million and they're not going to take any withdrawals from that million because their lifestyle needs are met by the Social Security and pensions and
Yeah.
whatever other income they may have, then there's no need to make withdrawals.
Right.
So it
And if
all
I
relates back to the bucketing strategy that we do. But again, if we're not going to make withdrawals, why be overly conservative?
exactly, yeah, and I want to touch on that bucketing, but I think this again speaks to, generally speaking, I would say this is correct.
Yeah.
But what happens is people take these general rules and they apply them to their own situation, again, as they are gospel, as if they're true 100% of the time. Oh, I'm getting older, so I need to get more conservative. Generally speaking, across a large group of people, that's what should probably happen. If you look at what happens in target date funds inside of 401k, that's exactly what happens. And so it's not that we're saying that's wrong, but we have to understand why those target date funds and why this rule is even a thing, or this saying or this notion is even a thing. And it's because, generally speaking, Jay, as you get older, you're getting closer to taking money out of your accounts. So I'll throw it back over to you here in a sec. But as you get closer to pulling money out of your accounts, now they need to, or before you take them out, they need to be repositioned into investments that are more conservative. Why is that?
Because you're going to start making withdrawals.
Well, because the stock, because if you put them in something that's very aggressive, like, or just volatile, like stocks are more volatile than bonds and more volatile than a money market. They're going to do what? As time goes, they're going to fluctuate and go up and down. And so the last thing you want to do is put money into a stock and I have to make a withdrawal in, let's just say, in 6 months. Well, 5 months goes by. I still have everything in those stocks. And then we see a 30% decline in the market. Now what am I going to do? I just lost 30% and now I still have to take my withdrawal. Yep. So you mentioned bucketing. Maybe we can talk about that for just a brief moment here before we go on to the third one. And, I think in very simple terms, the way I view it, and I'll ask, how you like to talk about this, but the way I view it is you've got 3 buckets: short-term, mid-term, long-term. And you've got to put all of your money in one of those buckets. And there are certain investments that are really designed for different periods of time. Some are really better for long-term, i.e. stocks. Some are better for short-term, money market, CDs. Those are not bad investments. They're historically, they've been bad long-term investments, but they're good short-term investments. So it's all about just finding out, how much money am I going to need in the short term? How much am I going to need in the midterm? Putting enough money into those types of investments, money markets, bonds, and then the rest can go into that long-term bucket.
Yeah, exactly how you said it, Joe. It's, there's the 3 buckets and each bucket is designed for its own purpose, right? So in the short term, we want to have cash because we know we're going to start making withdrawals from it.
Yeah.
In the midterm, we know that, we may need money for longer than 1 year and
Sure.
stocks could be down for longer than 1
year.
And
I would jump in, Jay, and say that right now, as we record this, that first bucket, we used to say cash, basically, it really didn't matter what we said in that first bucket, whether it was cash, money market, CDs, because none of them paid anything. So you were fine just putting money, in your backyard, burying it, or putting it in the freezer compared to a CD, because you weren't going to get much different. Now, I will say that has changed a little bit now. If you want to speak on that just for a moment too, the fact that first bucket, we actually have options now. It's kind of fun.
Yeah. I mean, what we've done with some clients is you start to, with the rates on how they are, you can start to build out short-term CD ladders as far as 3 months, 6 months, 9 months. So then you can peel off a little bit more interest, even though you know that you're going to make those withdrawals in a year.
Sure.
Because
Yeah.
again,
So
it pays a lot higher than what your normal savings account does typically. And
yeah.
then again, it's just a different environment with the way interest rates are. Where
Yeah.
again,
But
beforehand, everything pretty much paid about the same, which was
sure.
nothing.
Yeah. So if we have CDs out there now that are paying 3.5%, for 3 months, or, let's just say 4% for 12 months, when rates change. So that's just a hypothetical. But if I do that and I look at a return after 12 months, I'm thinking, wow, that's a great 12-month return compared to what we've seen, the last 10 years or more. But if I just repeat that over and over and over, and if those rates stayed the same, getting a 4% return over a very long period of time, not incredibly ideal, right? In other words, well, we think historically, if you look at historical returns, we think, hey, these other investments, they've done better historically than 3%, than 4%. So great short-term investment, not a great long-term investment. And then we use bonds. We look at bonds as a nice bridge in the middle. But these things evolve, and we have to evolve with them. But we spend a little bit more time on that one, but I think it's merited, because that's such I hear that all the time, that I'm getting close to retirement. I need to be more conservative. Sometimes that's not the case. And if you can handle it emotionally, and your money's going to be sitting there untouched for 25 years, might not be a bad idea to open yourself up to a slightly more volatile portfolio, if that volatility means, hey, I'm expecting a higher average return. Yep. And it leads into the next one too. The third one, Jay, you have to avoid market downturns when you're retired. True or false?
Yeah, false. The thing when it comes to, if you're trying to avoid market downturns, that means you're also trying to time the market. That's the only way you can put that.
Yeah,
and
well,
we know that it's
I would say,
impossible to time the market. So
I would say I think that's what people are saying.
Yeah.
Now you could avoid the market downturns by not even being in the market, and just, being in CDs all the time. That's one way to avoid them. But we're talking about, like you said, when people say this, they're talking about
time in the market.
Timing.
Yeah.
And now, I'm going to speak as the average investor out there, which this makes total sense. I would say, it seems to make total sense, Jay, but Jay, you're an advisor. You're a smart guy. Why can't you can't you sort of foresee what events are going to take place? And isn't that what you do as an advisor, to try to foresee different events and then move investments around? Is that not what you do?
Yeah, I always tell clients, I say, if I had the crystal ball or the magic ball that would allow me to see those types of events, I wouldn't be here. I'd be out in the Bahamas. I'd be, sipping on Mai Tais or whatever it is. And because I'd be able to time the market. So no, that's not what we do. Again, what our job is as part of it is to really, when it comes to market downturns, is helping the emotional side of it. We know that the market is going to come down always at some point. We never know when that's going to be. And it's not, hey, let's stick our head in the sand and ignore it. It's just monitoring through those times. Let's, on the emotional side, stay invested. And, during COVID, that was a great example, right? We, saw at least a 30% down pull, and it was very easy to let your emotions take over and want to get out, want to sell, or say, or even right now too.
Yeah.
But you never know when the market's going to come back up. So when it comes to trying to time the market, I always tell people, you don't only have to get it right just once, you have to get it right twice. You have to get out, okay, when do I get out? And then when do I buy back in? And I've at least seen time and time again where some people got out at the right time, but then they never got back in the market.
Yeah.
And they've sat on the sidelines for the last 2 or 3 years.
Right.
And even with that, the market's up, even with all the downturns over the last 2 or 3 years. So,
yeah, I agree. I've seen the same thing. And people think if they get out at the right time, then they feel like, oh, I won. I was right. I told you so.
Yep.
But the problem is, yeah, very rarely am I seeing those people jump back in, because the best time to jump back in is really when things are at their worst. And we don't know when they're at their worst until we start to recover, and until things are really all better. Then we look backwards and we say, oh, that was the lowest point.
Yeah.
Nobody, I'll say this, hardly anybody wants to invest more when things are at their worst. Now, savvy investors know that, hey, this makes sense and we should do this. So, I'd say the average investor is not comfortable taking large amounts of money and investing whenever things are at their worst, especially the kind of investor who is trying to time the market and who, generally is more conservative. They're trying to avoid these market downturns. They're not the type to generally speaking, to say things are at their worst, things are at a low point, I'm going to throw money in because I'm trying to make a big return here. It's usually more of a defensive strategy that I just want to avoid it because I don't have enough time to recover. I'm getting older, whatever the reason may be. But the truth is, the average bear market, according to Capital Group, and we've talked about this before, through 2018 at least, has lasted about 14 months. If you look at the data there. So 14 months, the average bear market, and the average bear market has gone down 33%, whereas the average bull market has gone up 263% and has lasted for 71 months. So, I mean, if you know something that we don't, or, you're not going to be here, for even a couple of years, that may be different. But most of us, especially with those that are getting ready to retire, they're 55, they're 60, they're 65. Generally, we sit across the table and say, we have to think that you're going to live at least to near an average life expectancy, unless there's something health-wise that would tell us otherwise. So you kind of have to plan for that. And there's still plenty of time. Even someone who's 70 years old, if they live to 85, that's 15 years. So yeah. The average bull market lasts about 6 years. The average bear market only lasts 14 months. So you do have time to recover. You just have to make sure that your buckets are set up properly. So that's number 3, Jay. Now we're going to switch gears and go into a different topic here, but this is one that I've heard several times this year. In fact, we helped a client retire who hadn't yet retired because of this myth. And we showed him and his spouse that, hey, it's okay. You're okay to retire. And the myth is you need to have your mortgage paid off in order to retire. Got to have your mortgage paid off first.
Yeah.
Any comments on that?
Yeah. You hear it time and time again. Now, yeah, don't get us wrong. It definitely is a good feeling to have the mortgage paid off.
Right.
It definitely feels good not to have that monthly payment, own your house outright. But is it needed? No, it's not needed to be able to retire. Right. And even sometimes I've seen it where, as some of our clients get closer to retirement, different environments, more so last year when rates were at an all-time low, but sometimes it even made sense to take out a little small mortgage on your house. I mean, I know that I saw that a couple times where they had some debts here or there, and it was, hey, let's consolidate it all.
Yep.
Let's spread out the payment and get it at, at one point there was the low interest rate of about 2.5%, 2.25%.
Yeah.
Where it was, it made all the sense in the world to consolidate some debt, stretch out the payments, get it at a low rate, and then that was able to allow them to retire.
Right.
Again, different environment, rates are at a different time now, but again, it's, if you went into that, methodology last year of, well, I have my house paid off, but I have these other debts, I can't retire.
Right.
No, it doesn't. There was a good opportunity last year to do some of those things.
Yep. And for some people, Jay, this, meeting with clients, prospective clients, and those of you listening, I'm sure you can relate. But some people, they want to retire yesterday. They are not going to their job every day with a bunch of gusto and energy and excitement. They are looking forward very much to the day they can retire. So think about that. I mean, if you have a mortgage that you're trying to pay off, and there's 3 or 4 more years or 5 years or 6 or whatever it is, and you just think, man, I can't retire until I pay that off, and you are doing everything in your ability to pay that off, think about that versus doing a financial plan, a retirement plan, finding out that, hey, Jay, like you said, Jay, hey, we may be able to even refinance. We could go out 15 years, and lower the payment from where it is today, and we're fine. And I can retire now. Maybe it's 3 years early, maybe it's 5 years early. Think about the lifestyle difference and the life impact of that decision of being able to retire a little bit sooner. Now, is it good to have your debts paid off when you retire? Of course. Of course, it's more beneficial to have your debts paid off because you're not going to have that same cash flow obligation every single month. So we're not saying don't pay off your debts, but we're just saying if you're out there and this is looming over your head, I've got this mortgage, I still got 12 years to pay on it, I'm never going to be able to retire. Not necessarily. If you've done a good job saving, if you've got income sources, you might be able to retire. Now, it might mean you have to take more withdrawals in the short term. And that's, again, we talked about bucketing. That's where that's going to come in. But if you plan it out, you might find that you can still retire. So do you need to have your mortgage paid off or all your debts paid off? No. Does it help? Sure does. If you
and it feels good.
And it feels good. But all right, the last one, Jay, this is one that is almost accepted as common knowledge, I would say, and almost agreed upon by each and every person that we go in and talk with. But it's, you will have a lower or low marginal tax rate in retirement. So maybe just talk about, again, first off, I'll lead this in with, generally speaking, this is probably found to be true more often than not. But Jay, maybe talk about some of the scenarios or reasons why this is not always true.
Yeah. So, exactly like Joe said, generally speaking, it is mostly true. Most of the time when we see clients, they are, they have less income than what they did at their peak earning years. So they are going to be in a lower marginal bracket.
Yep.
But some of the things that we can't control or don't see that can drive that bracket up higher is, again, it may be, okay, we have more than we need when it comes to turning on the Social Security, the pension, withdrawals from investment accounts.
Mm-hmm.
It also depends how you saved your money for retirement, what buckets that money's in. If it's all in pre-tax money, then when it comes out, all the money that's now showing up is now taxable. So It's good to have a mixture between Roth, brokerage, and still pre-tax money, so then we can mix and match when it makes sense.
And I see that, Jay, just to jump in, I see that a lot too, where a lot of times people save everything for retirement into a pre-tax account, into a pre-tax 401k. And not that that's a bad thing. I mean, if you've done a great job saving and you have a huge pre-tax 401k account or traditional IRA or something like that, that's great. But you're right. What that causes is, now when I go to take out withdrawals, every dollar I take out is taxed just like, it's ordinary income. So it's fully taxable at that time because none of it's been taxed yet. Not to mention that, a lot of 401k plans out there, I think I'm seeing a lot more with that Roth option, but not all plans offer the Roth 401k option. And then any money put in by employers is all going in pre-tax. So right off the bat, you're more likely to have more pre-tax dollars when you retire. And then the other thing, Jay, is, maybe you can talk on this, but when you hit the age that you have to start taking money out, which right now is 72, you have to take required minimum distributions at that age, and then every year after. That distribution is going to be based on the amount of your pre-tax accounts and whether you need it or not. So maybe just talk about that a little bit.
Yeah. So those are the kind of the uncontrollables that, we talk about when, if you do have a large pre-tax account, that's the only money you have or whatever is in there, you have to start taking money out at 72. So again, even if let's say your lifestyle is met between Social Security, pension, and maybe you only need a little bit of a withdrawal from your retirement accounts. Well, doesn't matter when you're 72, whatever that amount is, that's what you have to take out. So sometimes it may exceed what your expenses are. What I've even seen in the past is clients are such good savers and they saved it all into this account to where you kind of see a bowl, right? It's high income, then it drops very low, and then it raises up a lot because at 72, I mean, they're having more come in than what they almost sometimes even made beforehand because they were just such good savers.
Right. So let's back up there because I think that's important. I've seen that too, where you're earning, during your earning years, your wages are high. Then you retire, let's say at 60, 62, to, whatever. And then your income goes down because maybe you don't even spend much money and your income goes down. And for until age 72, it stays down. And then at 72, all of a sudden, Uncle Sam says, you've got to take out $50,000 a year from your IRAs. And the client says, well, I don't need this. I don't need this money to live off of. I'm fine. That's the statement that really gets, and it really sticks out to folks that I talk to as I tell them, you have to take this money out whether you need it or not.
Yep.
And why is that? Because you have to pay taxes, because the IRS, it's just part of the system. You've got tax deferral. You've received tax deferral for that amount of time, the amount of time that the money's been in there. At 72, Uncle Sam says, that's enough. You have to start taking money out so that you pay taxes on it. And all the amount you have to take out, it's not the full amount in that year, but it's a percentage of the account balance. And that goes back, if you want to look that up, it goes back to the Uniform Life Tables in Publication 590, where you can look that up. But generally speaking, let's just call it, let's round here, it's around 4%. And then that actually goes up every year. The percentage goes up every single year because your life expectancy is getting shorter. And so you have less years to take out the balance of your account. So Jay, I've seen people that during those years, they, like you said, they might be withdrawing and having a total income of $200,000-$300,000 a year in retirement. And maybe, like you said, they might have not even made that much during their working years, but whether they did or not, they never thought for a second that their gross income would be that high in retirement, because they never figured we're not going to need that much money. So that's a problem. It's a good problem, but it's a tax problem. And what's one thing that people can do, because we don't want to tell people don't save money. I mean, if you're young enough, maybe you can save into a Roth 401k, but let's just say you're sitting here listening to this and you're 60 years old. What can you do now to kind of lessen the impact of that problem that's going to occur when you turn 72?
Yeah, if you're in those, let's call it the bottom of the bowl years, then you could do Roth conversions, right? Depending on what buckets you have, you could do Roth conversions during those lower income tax years up until you hit 72 to minimize what that taxable amount is going to be at 72 or whatever you have in pre-tax.
And so simply, that's just
simply what a Roth conversion is just taking money from your pre-tax bucket, moving it over to your Roth IRA and paying taxes on it when you make that conversion.
Yeah.
But it's taking money out in those lower tax years and moving it to a bucket where you don't have to take RMDs out, because Roth IRAs don't have a RMD 72 rule.
Yep. And we always recommend speak with an advisor, an investment professional, a tax professional before doing something like a Roth conversion. There are lots of implications other than just your marginal tax bracket. Medicare could be affected. Your pre-Medicare health insurance that you have through the exchange through healthcare.gov could be affected. So you need to talk with a professional before doing something like that. But that is something that you could consider to smooth out your income instead of having that bowl, like Jay said, smoothing out that income so that you pay less taxes down the road. That's about it for time, Jay, for this part one of this series, this 2-part series on the myths of retirement. We're going to come back in part 2 and talk about more. But if you're listening out there and you've heard a couple things that you want to dig into deeper, go to retirementpowerhourpodcast.com. On our website, you can click Work With Me, and you can take the first step to getting a free retirement analysis, which is just setting a 30-minute phone call. And you're going to talk to me, and we're going to have a conversation and see what it is you need help with, and see if we're a good fit to help you and how we might be able to best do that. So that's it. The first step, go to retirementpowerhourpodcast.com, click Work With Me, schedule a call, 30-minute call, and you'll talk to myself, and we'll see what we can do for you. So Jay, thanks for taking some time for this segment. We're going to be back for part 2 and talking more about these myths of retirement, and look forward to that as well. So appreciate your time.
Yeah, absolutely. Thank you, Joe.
All right. And everyone else, thanks for listening to this episode of the Retirement Power Hour, where we help listeners invest wiser and retire better. Take care.
Thank you for listening to the Retirement Power Hour podcast. All material discussed on this podcast is for educational purposes only and should not be construed as individual tax, legal, or investment advice. Investing involves risk of loss, and investors should be prepared to bear potential losses. Past performance may not be indicative of future results. Joe Allaria is an investment advisor representative of Carson Allaria Wealth Management, a registered investment advisory firm. Information discussed on this podcast may be derived from third parties that are believed to be reliable, but Carson Allaria Wealth Management does not control or guarantee the accuracy or timeliness of such information and disclaims all liability for damages resulting from such sources. Any references to third parties are provided as a convenience and do not constitute an endorsement.